When I first started trading ICT, everything felt confusing and overwhelming. The strategies, the jargon, the complexity, it all made me feel like I'd never get it right. But everything changed the moment I simplified my process into a clear, foolproof system. That's when I started seeing consistent profits. Now I'm going to show you exactly the step-by-step method that took me from being lost to consistently profitable. If you want to learn how to turn ICT into a simple, reliable way to make profits, stick around, this video is for you. The very first and most important rule in ICT trading is don't try to learn every single concept at once. For now, I want you to focus on just a few key ideas, ones that have helped me the most, without getting lost in everything else you'll see online. The two concepts I want to focus on are liquidity and inefficiency. For liquidity, think internal range versus external range liquidity. For inefficiency, we're talking about fair value gaps or volume imbalances. These are the only two concepts you really need to understand market context. Once you master these, you'll be able to determine the overall direction of the market, and that's really all it takes to consistently profit. Let's start with liquidity, specifically, the difference between internal range liquidity and external range liquidity. Imagine a specific price range. The outermost boundaries of that range, like swing highs and swing lows, are considered external range liquidity. Anything inside that range falls under internal range liquidity. Markets usually retrace to internal range liquidity before targeting external range liquidity again. This behavior actually helps us identify trends. For example, when the market is moving down, it creates lower highs and lower lows. But as it takes out external range liquidity, it often pulls back into internal range liquidity first, giving us a clear picture of the trend. As the market moves, it often creates lower highs or higher lows within a new range, forming what we call the internal range. This internal range is basically built on retracements while the market continues drifting higher or lower. My approach is to position myself inside internal range liquidity while targeting external range liquidity. Some traders, especially counter-trend traders, prefer to do the opposite. They take out external range liquidity and then try to trade back into internal range liquidity. While this is possible, it's much trickier, because you never know exactly where the market will stop or target inside that internal range. So, how do you easily tell the difference between internal and external range liquidity? Let's break it down using just one time frame, for example, the weekly chart. Imagine we have last week's high and low. If the price is trading within that range and hasn't broken the previous week's lower high, we're in internal range liquidity. Now, if our bias is bearish and we expect the market to push lower, the previous week's low becomes our external range liquidity target. That retracement within the internal range is where we can position ourselves strategically, aiming for the market to eventually create a lower low. The concept applies across all time frames, prior month, week, day, or session highs and lows. Trading inside any of these ranges means we're in internal range liquidity. Our goal is to make an educated guess about the next external range target. Which time frame you focus on also affects your trading style. Swing traders might look at weekly or monthly levels, while day traders focus on daily or session levels. Understanding where you are within these ranges is key to making smarter trades. Even with all this knowledge, you still need to do the work. There's no substitute for seeing these concepts play out in real time. That means backtesting and forward testing in the live market. Here's what I do. I go into the charts and mark important swing points, like prior day highs and lows, prior week highs and lows, or significant levels. Once these levels are marked, your job as a trader is to observe how the market reacts after taking out these key points. Watch carefully. How does the market behave when it hits a prior day low? Or a prior week high? The real learning comes from seeing these reactions unfold live, and over time, this experience is what turns concepts into actionable knowledge. We also want to mark old swing lows and highs, because these levels are crucial. Once the market takes out liquidity, the big question is, where will it go next? Most of the time, after hitting liquidity, the market trades toward the opposite end of the range or moves into an inefficiency left behind. For example, after taking out prior day lows, it might move toward prior day highs or a leftover fair value gap. As a trader, your job is simple: mark these key levels, then watch and learn. Do some backtesting and forward testing, and observe how the market reacts after liquidity is taken out. Over time, this experience builds the intuition you need to trade these moves confidently. So, what does the market do after taking out old highs? Typically, it pulls back to take out internal range liquidity before it's allowed to push higher again. For example, after breaking prior day highs, the market often retraces to absorb internal range liquidity before continuing its move. The same principle applies across all time frames: prior session, day, week, or month highs and lows. As a trader learning liquidity, your task is simple: mark these key levels, prior month, week, day, and session highs and lows, and watch how the market reacts after taking them out. Look for sharp responses and notice how the price often moves toward the next liquidity point. This observation is where your trading intuition starts to develop. Once we've got a handle on liquidity, the next concept to understand is inefficiencies. For me, the easiest inefficiency to spot is a fair value gap. If you're not familiar with it, think of it as a 3-candle pattern. For example, 1. The first candle moves down. 2. The next candle moves even lower. 3. Then the third candle opens, wicks higher, but doesn't fully retrace the previous low. This creates a gap in price, where the market hasn't fully filled the movement. This is the fair value gap. What tends to happen next is the market trades into this gap, refilling it before continuing its direction. Now, just for perspective, I'm not a market maker, so I can't say exactly how the market works, but you can think of fair value gaps as footprints of large orders. Imagine a bank or institution wants to buy or sell billions of euros. They can't fill the entire order at one price, so partial fills create these gaps. The market then often revisits these areas to absorb the remaining liquidity before continuing its move. What happens in the market is that large players shift the price to fill their orders. To sell at the price they want, the market often has to trade higher first, filling in any inefficiencies along the way before moving lower again. If we look at the charts, you can see this in action with fair value gaps. This process often repeats, creating multiple fair value gaps, each being respected by the market. What's interesting here is that we're not just seeing inefficiency, but also internal range liquidity being formed. By combining these two concepts, inefficiencies and internal/external range liquidity, we can get a much clearer understanding of where the market is likely to move, especially on the higher time frames. Here we have a fair value gap, and just below it, you can see internal range liquidity, these short-term lows. If your goal is to position yourself and target external range liquidity, you might focus on the highs up here. You can see a repeating pattern: internal range liquidity gets taken out, inefficiencies get refilled, and then external range liquidity becomes the target. Using these concepts together is incredibly powerful. But here's the catch: understanding these concepts alone won't make you profitable. Without a consistent routine and disciplined practice, even the best strategies won't work. A proven routine for a professional trader revolves around discipline, preparation, risk management, and continuous improvement. Here's a breakdown of what my weekly routine looks like. 1. Weekly chart review weekend. From Friday to Sunday, I review my weekly charts to get a sense of where the market might go. I look at the current weekly candle and try to predict whether the market will trade to external or internal range liquidity. For example, if the weekly candle is an inside candle, I mark external range liquidity at the highs and internal range liquidity at the lows. I also note swing lows, swing highs, and any fair value gaps on the weekly time frame. This helps me anticipate whether the market will continue the trend or potentially retrace into internal range liquidity. Typically, I don't bet on the market retracing to internal range liquidity during a strong trend. It usually just creates higher highs and higher lows, or lower highs and lower lows in a downtrend. Number 2 is economic calendar review. Next, I check the economic calendar to see what's happening during the week. I treat it like a treasure map. High-impact events like NFP, FOMC, rate announcements, or CPI can create volatile conditions, so I usually wait until these are over before trading. Low to medium impact events I might trade around if I have a strong opinion. Number 3. Daily preparation, every night. Every evening, I review the daily candle and plan for the next day. I focus on targeting previous day highs or lows, but only when I have a strong directional bias for the daily candle. Number 4. Trading session morning. My main trading window is usually 9 a.m. to 12 p.m. During this time, I execute trades based on my pre-identified levels. Sometimes I hold trades overnight or into rollover periods, but generally, I exit by lunchtime. And finally, number 5. Personal routine and journaling, afternoon/evening. Later in the day, I like to work out to stay sharp and focused. In the evening, after dinner, I journal and review my trades. This process shouldn't take too long. If it does, you might be trading too much or overanalyzing. The key is to keep journaling simple and consistent. By following this structured routine, you combine preparation, discipline, and observation to trade with confidence while continuously improving over time. After every trading session, I ask myself, did I follow my rules? Did I stick to my risk management? Then I reset and clear my mind for the next trading day. The goal is simplicity, a routine you can repeat day in and day out. Ask yourself every day, are we targeting liquidity or inefficiency? Are we trading to the prior day's high or low? Once you have these daily actions down, you've built the foundation for trading like a pro. Now comes the most important part, the strategy. Imagine having a clear set of rules that makes the decisions for you. Would you trade better? Absolutely. So far, we've broken down the key concepts needed for trading. Now we need a precise entry strategy, a clear set of rules that makes decisions for you. The first question is the market moving toward liquidity or toward inefficiency? If the market has already traded through an inefficiency, then our objective is to look for price to move toward external liquidity, and we position ourselves in that direction. On the other hand, if the market has already taken external liquidity, we don't trade against it. Instead, we wait for price to move back toward internal liquidity, such as an inefficiency or session liquidity. One important note here, we always trade with the bias, never against it. This is exactly where most beginners fail. They form a bias on the higher timeframe, but as soon as they drop down to a lower timeframe, they start taking trades against that bias. That's why I always say, if your higher timeframe bias is bullish, don't take bearish setups. If your bias is bearish, don't take bullish setups. This forces you to be patient and only take setups that are aligned with your bias. Once I've established my bias, I only look for entries that include fair value gaps, turtle soup setups, and inverse fair value gaps. What this approach allows me to do is patiently wait for setups that align with my higher timeframe direction. Until a valid setup that matches my plan appears, I don't take any trades. When you have a plan, you trade that specific plan, no guessing, no chasing setups. This is exactly the system I used to go from being a beginner to becoming a profitable trader. It's the system that completely changed my life. Now, let's look at a few chart examples. First things first, is the market trading toward liquidity or inefficiency? Looking at previous day candle, we can see the market has already traded into inefficiency here. Since we're in an uptrend, the market is forming higher highs and higher lows. I don't want to see it retrace all the way down to that inefficiency. Instead, I want to see previous day high taken out and then a move toward external range liquidity. This could be up here or just to the prior weekly high. Either way, it gives us direction for the next day. So when I sit down on evening, I already have a bullish bias based on the current price action. For the market to be bearish, we would need to see a market structure shift, displacement lower, and a bearish fair value gap driving price down, but we don't have that. During the intraday session, I'm looking for session liquidity or previous day liquidity to be taken out before positioning long. This sets me up for a high probability trade in the direction of the trend. On the charts, you can see Asian range lows and prior day lows in play. My target is external range liquidity up here, but on lower timeframes, I'll show you exactly why I entered and exited at a specific price and time. As we head into the New York session, the market takes out Asian range lows. I'm looking for price action that aligns with my timing and bias. Remember, my bias here is bullish, so I'm not looking at bearish setups. I'm only hunting for bullish entries, which might include bullish fair value gaps, bullish turtle soup setups, or bullish inverted fair value gaps. In this example, we hit a bullish fair value gap, giving me a bullish setup. I entered at this midpoint FVG, using internal range liquidity from the Asian range lows, and my target was previous day highs above, which act as external range liquidity on a lower time frame. My price target is the previous day's high, which, based on my stop loss, gives me a 5R reward. Notice why I placed my stop loss a few pips below the FVG. Because right below the FVG there is an order block, and in many cases the market tends to tap into that as well. So keep this point in mind. Here I am on the 5-minute chart. If you're struggling on very fast charts like the 1 or 5 minute, move up a time frame. It gives you more time to react, plan, and execute properly. Finally, the most common mistake that ruins beginners is poor execution. Many traders come in with a bias on higher time frames, then chase setups on lower time frames against that bias. To avoid this, stick to your higher time frame bias. Ignore setups that go against your narrative. Only trade in the direction aligned with your bias. This discipline is what separates consistent traders from those who struggle. What this approach allows me to do is wait patiently for setups that align with my higher timeframe bias. Until a valid setup appears that matches my plan, I don't take any trades. The hardest part of trading is filtering out trades that don't make sense. Too many traders sit in front of the charts and take any trade that pops up. That's not how professional traders operate. Here's the key: plan ahead. Sit down the night before and decide. Do I wait for session liquidity to be taken? Do I wait for previous day liquidity? Is the market trading toward liquidity or inefficiency? Am I trading inside a fair value gap, or after a daily low/high gets taken out? Once you have a plan, trade that specific plan. No guesswork, no chasing setups. This is the exact system I used to go from a beginner just like you to a profitable trader, a system that changed my life forever. If you found this video helpful, make sure to subscribe so you don't miss future lessons.